Is crypto a good investment during stagflation? Does this fearful combination of inflation and stagflation bode ill for crypto trading, or is crypto outside of its influence? But is stagflation really going to knock the economy's lights out just after it came back on its feet? What exactly does stagflation mean, and where does it come from? Most importantly, does crypto have to fear stagflation? In this video, we're going to be talking about stagflation, so how it works, and also what it means for the economy, stagflation and crypto, why stagflation is likely bad news for crypto investing during stagflation, so how Bitcoin, Ethereum, and altcoins could actually trade during stagflation, investing during stagflation, and a look at other asset classes and how to stay in the investing game. And of course, we want to hear from you about what you think about stagflation and what the consequences on crypto could actually be, so let us know that in the comments below. What is stagflation and how does stagflation work? Stagflation is a combination of stagnation and inflation. And you know it's bad when they combine two negative words to make a new one. Put simply, stagflation means inflation and unemployment are increasing while the economy is slowing down. Stagflation is one possible consequence of inflation, and inflation can come from two sources. There is demand-side inflation, so the economy is doing great, so consumers start asking for higher wages, and producers increase prices for maximized profits. And then there is supply-side inflation. Important input factors become scarce, and their price spikes suddenly and unexpectedly. And this can take many forms: an oil price shock, a shortage of labor, or supply chain bottlenecks. And if you've been paying attention, you may have noticed that we are currently experiencing a supply-side inflation for several of the above listed reasons. Cue rising energy prices, chip shortages, and COVID lockdowns impacting several sectors. And everyone's fear now is that this may lead to stagflation. Stagflation is worse than inflation because it is harder to combat and can take longer to actually shake out of the system. We already ticked the first requirement for stagflation, which is inflation. And so what about the others? Currently, the price of oil and gas is spiking, and that came as a surprise and is making everyone's lives more expensive. Plus, we already had supply chain problems due to the pandemic. Policymakers fear the economy may be entering a recession, meaning that we get 2 consecutive quarters of negative growth. And a recession causes unemployment to increase. So what can be done about that? Well, one tool policymakers have is monetary policy, i.e. lowering interest rates. And if interest rates actually decrease, capital becomes cheaper, and banks are incentivized to lend, and investments increase, and as does consumption. Unfortunately, there is a conundrum. If we lower interest rates, capital becomes cheaper, but this increases inflation. But we already have inflation, and in fact, we've been doing the opposite and have been increasing interest rates. All this time, we've been making a recession more probable by raising interest rates, and that is the stagflation trap. Inflation is rising, so you need to increase interest rates, but those rate hikes make a recession more probable. In a recession, you should lower interest rates, but that drives inflation. To add insult to injury, the anticipation of inflation can worsen things, and consumer behavior is reflexive, and if you expect goods to become more expensive, you buy today rather than tomorrow and fuel the same inflation you fear. One famous example of stagflation happened in the 1970s.
Well, right or wrong, oil prices are moving definitely upward.
And as a result of the supply side shock, the Fed hiked the interest rate to a unheard of 20% interest rate in the US. And also unemployment spiked as well, while GDP growth was negative in the years when interest rates peaked. Stagflation arises when the economy experiences a supply side shock beyond its control. Commodity prices increases are a good example. If the price of oil suddenly increases, the economy suffers, although that impacts the US much less than it does resource-dependent Europe. So does stagflation always have to lead to a recession? Well, not necessarily. It depends on how the central bank actually reacts. Let's take a look at 3 scenarios. A hawkish stance, so the central bank tries to fight inflation hard. A dovish stance, so the central bank doesn't do much. Or the middle way. A hawkish central bank. The interest rate is sharply and significantly hiked. Inflation should decrease swiftly, but the risk of a recession increases. A dovish central bank, so the central bank hikes the interest rate less. Inflation could persist or even increase depending on how quickly the supply side shock recedes, and a recession is less likely. Or a middle way, so the central bank tries a bit of both, and it can talk tough but signal flexibility while it monitors the economic situation. And this can go either way since the strategy is more reactive. And in reality, the optimal solution is unclear. The Fed is currently mostly pursuing a mix of the middle way and a hawkish stance. Policymakers also use fiscal policy, i.e. spending government money to tackle the problem. So what does stagflation mean for crypto? Well, first things first, crypto is a risk asset. And that means when investors feel like investing in riskier assets, they buy cryptocurrencies. And that happens in bull markets. In recessions and bear markets, investors sell these riskier assets. Put simply, recession means bear market, which means crypto goes down. For proof that crypto is a risk asset, look no further than its correlation to the Nasdaq, another risk asset, and its unclear correlation to gold, a risk-off asset. And this intuitively makes sense. During inflationary periods, investors prioritize capital preservation, and this means assets that preserve value like gold do especially well. And the same thing is being said for Bitcoin, but we'll have to take a look at that. Just take a look at its big bull run leading into the 1980s. Admittedly, lifting the ban on owning gold in 1975 helped, but gold has traditionally been an inflation hedge. Compare that to the performance of the stock market, which traded sideways for most of the 1970s. And of course, not all equities are created equal. Even during a recession, some sectors outperform, such as the commodity-based companies during times when commodities are expensive. And with all that said, crypto has already reacted and taken a 70+% beating from its all-time highs. Many analysts actually expect another leg down if the economy officially enters a recession territory and possibly doesn't recover quickly. How cryptocurrencies fare during stagflation? If equities are not created equal, shouldn't the same be true for crypto? Maybe not all cryptocurrencies are going to zero with haste. Well, yes and no. Let's split crypto into three big buckets: Bitcoin, Ethereum, and other altcoins. Bitcoin, aka digital gold, is actually cheap now if we consult the Bitcoin price temperature, or BPT. The BPT measures the distance between Bitcoin's current price and its 4-year moving average. Put simply, it measures if Bitcoin is cheap now, not by historical standards. However, for most of Bitcoin's existence, the Federal Reserve has been in money printer go burr mode. And the only time when interest rates briefly spiked at 2.5% at the beginning of 2019, Bitcoin was not doing well price-wise. And when capital became cheaper, Bitcoin rallied. So much will depend on if and when Bitcoin can break its correlation with other risk assets and really be perceived by markets as digital gold. This process will likely not happen quickly. On a multi-year time frame, an entry price at and around $20,000 looks solid, given the likely permanent expansion of money supply and increasing awareness for crypto. However, if the economy enters a recession, the bottom may still not be in. Ethereum has almost a perfect correlation with Bitcoin. Most somewhat experienced crypto investors know that Ethereum really is just Bitcoin with a higher beta, aka higher percentage highs and lower percentage lows. Ethereum does not have Bitcoin's potential adoption angle of being a fully decentralized payment ledger, but that's not what it's trying to be. Ethereum is a decentralized world computer, a sort of decentralized Windows that anyone can use. While Bitcoin is now understood to be a digital commodity, even by Gary Gensler, it's not clear whether ETH is one. ETH is structurally more similar to a high-risk equity with clear leadership structure, the Ethereum Foundation. Furthermore, Ethereum has the merge coming up, and this switch from proof of work to proof of stake could be bullish for ETH if the transition goes well, or it could be bearish if this first ever switch leads to an unexpected problem and also some consequences. Either way, the price of Ethereum will almost certainly follow Bitcoin and not lead it. It depends on your risk assessment whether the merge is a potentially bullish surprise that justifies more downside in the short term. And finally, all other altcoins are even higher beta and make even higher highs and lower lows. During a bear market, they can bomb hard even if the bottom is seemingly already in. Just take a look at XRP's performance between March of 2018 and December of 2018, when it lost more than 50% after losing 70% in Q1. You should size all altcoin investments very carefully. Look for utility and use cases such as DEXs, profitability like incoming trading fees, and a strong community of die-hard supporters. So do you invest during stagflation? Okay, so crypto is bad and cash is bad because of inflation. Is there any way to escape becoming poor? According to Lynn Alden, there are a couple of rules of thumb to follow for investing during stagflation. Cash and bonds are okay, but your capital will get diluted. Expect to lose a few percentages with rising interest rates. Stocks likely to go down, especially with high growth stocks that backload a lot of potential earnings, and a lot of crypto follows high growth stocks, so rallying hard during bull runs and tanking badly during bear markets. Real estate, a solid investment for capital preservation. You will likely preserve capital in inflation adjusted terms, but you sacrifice liquidity. And then there are commodities. So commodities are among the best investments during stagflation. However, investing in commodities is tricky for retail investors. Do you know if oil at $100 is expensive? What about wheat at $800 or uranium at $50? And then then there are monetary commodities, so gold and other precious metals do pretty well. And Bitcoin is aspiring to become a monetary commodity, but it's not there yet. Investing depends on personal factors like your investment horizon, your risk appetite, and your liquidity preferences. If you are a crypto investor, first and foremost, the easiest course of action is to stay in cash and wait for a more benevolent circumstance. Preserve your capital and wait until the market looks less grim. Investing is easier with a bullish bias. So what's the conclusion here? While investing during stagflation is hard, everyone's a genius when it's all going up, but the market now is a player versus player elimination game, and it may be best to stay on the sidelines and wait for the dust to settle. What do you think? Let us know in the comments down below.